Hey, welcome to the Choose Kruse Podcast. My name is Ben Kruse. I'm here with my friend Mike Digilio. Today we are talking about how to get your offer accepted in this seller's market. We're still in a seller's market, and there's so many topics we want to go over today. But let's start with just a quick introduction to Mike Digilio. I've been working with Mike for many years now. He is a great friend and asset in this real estate business. And Mike, why don't you tell us about...
So Mike Digilio with Movement Mortgage. I've been a mortgage professional locally in the South Jersey market for about 20 years now. I've helped thousands of people make informed decisions about choosing the right mortgage. And we're going to talk about how not only do we choose the right mortgage, but how do we get your offer accepted in a really tough and challenging market.
So what are the key factors that buyers need to consider when kind of choosing the right mortgage product?
So that's twofold. One of them is you definitely have to choose a mortgage product that you're comfortable with, and you got to go through your budget. You got to understand your down payment, your monthly payment, your cash to close, and coming up with your financial plan is the key, number one critical step. In addition to that, you also have to think about what type of mortgage product may help or hurt you when presenting an offer to a seller. That's going to be key.
Yeah, that's something we've discussed many times.
Sure. For example, if you have the wherewithal to put a larger down payment, but you don't want to, that might help get your offer accepted when there's multiple offers that are out there. I mean, if a seller has 10 offers on a house, which is not uncommon in a really tough market, making your pre-approval stand out and your financial strength stand out is going to be super important.
Yeah. Talk to me about how you've got conventional VA, FHA, USDA. Talk to me about how those affect getting your offer accepted, how the seller agent and the seller see your offer, and how that kind of plays into that whole process.
So without going into a lot of details and intricacies of loan products,
we could get into the weeds.
Conventional loan products, if you could make a conventional offer in today's market, it's going to be a little bit more strategic. If you get an FHA offer, the seller might be concerned about FHA repairs. And if the seller's holding the keys and can make decisions on who the buyers are, an FHA offer might not be as strong because the appraiser has different standards when appraising the house. And if there's things that the seller needs to fix in order for the transaction to move forward, they might not be willing to do that. On a VA loan, there's protection for veterans. VA loans for veterans. And if you're bidding over asking price on a VA loan, sometimes listing agents and sellers might be hesitant, unfortunately, to look at a VA loan and say there's a little bit more risk on that transaction getting to the table. So it's a shame on one side because VA loan products are fantastic. It helps our veterans, and they could put 0% down. But if you're paying over asking price, agents are always going to look at if there's a gap in the appraisal, like what happens. So, loan products definitely are going to be something that buyers have to think about when coming up with a mortgage strategy in today's climate, for sure.
Yeah, and I want to shout out a friend of mine from Chicago, Kathy Yonda. You're familiar with Kathy? I'll put a link to her book. She's got a book on VA loans and the whole loan process. Really helpful information for veterans, because honestly, there are many veterans who have not even used the VA loan, don't even know that it's an option for them, don't understand the process, don't understand the benefits of it. So Kathy is a Marine and an agent from Chicago. I'll put a link to that info. You're always talking about this. You're always talking about using the mortgage process and the loan product in a way that, in an accounting way, that most benefits the buyer.
Oh, yeah.
In the long term.
Yeah. I mean, one of the things is getting a mortgage might be the easiest part of helping a home buyer. But coming up with a strategy to use that pre-approval and how that pre-approval presents itself to the seller to get the offer accepted, that could be the more challenging part. So whenever you're working with a buyer, you absolutely want to have a full deck of cards, and you want to know every angle that you can work financially with that particular customer to create a plan if we're in a strategic environment, to win an offer. Now, if we get lucky, there's not a competitive offer. And if there's not a competitive offer, then maybe you have different variations on how you would structure your pre-approval. But if you're going up against 3 or 4 multiple offers, creating, a pre-approval strategy based on the limitations that you have with the
Options
buyer.
are limited.
Yeah.
Yeah.
That's the thing where you really have to dig into. And a true mortgage professional is going to understand that. The challenge is, just like any other industry, there's a lot of reasons why mortgage professionals, sometimes struggle. Sometimes the professional just doesn't have the God-given talent to understand, how to put all this together.
Yeah, and this guy does. He does.
Well, I do my best, and thank the good old Lord for that. But I mean, there's a level of competency that some loan officers just don't have. And loans aren't easy. They're very detailed. You have to pay attention to details. And, it's mission critical when, one, getting the client approved, and then 2, getting their offer accepted. I mean, the loan portion of it, in my professional opinion, is a big piece in today's market on winning. I mean, it really is.
Definitely is.
Yeah.
That's an important aspect. The other aspect of it is buyers are losing their minds about interest rates right now.
Yes.
So maybe it's good for us to kind of explain what affects mortgage rates going up, going down, and maybe why they are where they are right now.
Yeah. So what I'm going to call the current climate over the last 5 years is, and it's challenging. We went from 2% interest rates to almost 8% interest rates at certain points. So I'm going to call the current climate, a lot of buyers have what I call as interest rate brain damage. They think that going out to the internet and reaching out to 10 different lenders is the best approach to find the cheapest cost of money. I always tell people, you don't shop for an interest rate, you shop for a lender. And what do I mean by that? If your lender can articulate back to you, how interest rates work, what drives them, what maybe causes movements in the market, and they're not paying attention to financial analysts and things that happen on a daily basis, rates could change a whole point within 1 week of the market being open. So, if your mortgage professional knows how the markets work, knows the key data factors to keep an eye on, that's probably the best way to, find an interest rate and decide when you ultimately want to lock that rate for your particular client. Today might not be the best day in the market to lock an interest rate. So what drives interest rates? The number one thing that drives interest rate is inflation. And, over the last 3 or 4 years in our economy, post-COVID, there was a lot of inflationary factors that caused interest rates to go through the roof. We had a lot of spending on the personal side, the business side, the government side, and we had inflationary times. We had supply chain issues. We've had, an influx of money that the Fed pumped into the market, to help people through difficult financial times. And that goes down to the home buyer, to business owners.
Trickles down.
There was a flood of money into the market that was injected. And, if you have money and you don't have product, it becomes an inventory challenge. And the law of economics doesn't lie. When you have an oversupply, prices go down. When you have a lack of supply, prices go up.
And right now, 2005, I was just looking at some statistics in the Philadelphia region. There were approximately 30,000 homes available at any given time. Right now, and for the past few years, it's about 10,000.
Oh, yeah.
It's a significant difference.
Yeah. I mean, so the key things that we're watching for interest rates right now is inflation data, the job market, that's important. If you see softening in the job market and high unemployment rates coming down the pike, that's going to help interest rates. Now, we don't like that because, people lose their jobs. And then the third thing that we're keeping an eye on is what the Fed's saying and what the Fed's doing. And there's a huge misconception is when you see the headline that the Fed cut the rate a quarter point, people think that interest rates go down a quarter point. That is false. That's for short-term cost of money. Mortgages are based on long-term securities. So, that's something that buyers need to be aware that, like, when they see the headlines, a quarter point came off the Fed today, that doesn't mean interest rates went down. Actually, when they made their first cut around mid-September, they cut the rates, and mortgage rates actually went up the next morning. So, but ultimately, long term, as the Fed eases the economy and inflation cools down, interest rates will follow that. So, but that's what kind of the ebbs and flows of what causes interest rates to rise or come down. And if your loan professional isn't paying attention to that or doesn't know how it works, you might question yourself, am I working with the right loan professional? Because that's what really drives it. And you're seeing volatility, in a 90-day window, you could see interest rates go up and down a whole point. And that affects affordability, affects people's pre-approvals. So it's a hot topic. And, going out and asking 10 different lenders to quote you a rate, first of all, if they don't know every piece of information about a particular buyer, including their credit score, the type of home they're buying, how much down payment they're putting, when is the closing date, right? If you don't know a closing date, you can't lock an interest rate.
Yeah, these are all negotiable terms in a contract.
So, and if a buyer goes out and starts calling 10 people, by the time they make the 10th phone call, the market already changed.
It's true.
So in fairness to each lender, you might talk to lender A one day, they quote you a rate, the next morning you wake up, the market changes, and lender B quotes you something higher or lower. How do you go out? You can't really time the market. Nobody has a crystal ball. But being in tune and educated on what the market's doing and the market conditions, that could ultimately help you.
That's why you say you're not really shopping the rate. You're shopping for customer service. You're shopping for someone who understands the market, where it's going, where it's been, where you're at the moment, which brings me to something you mentioned, locking the rate. Can you explain what that means?
Sure.
Why that's important?
So in the mortgage space, locking a rate, rates are published in increments of time. And typically, you can lock a mortgage rate for 15 days, 30 days, 45 days, 60 days. Some lenders movement, we can lock a rate up to 365 days. The longer the duration of the lock, the higher the interest rate a client will pay. And that's just due to, how mortgage rates, are assembled and the short term and long term, when you're trading and leveraging bonds on the secondary market, they don't know the uncertainty of the future. It kind of dictates how interest rates work. The longer the term, the higher interest rate you can pay because of the uncertainty of how the secondary market works. That's a little technical, but that's kind of a short answer on that.
Yeah, thanks for the short answer.
Yeah, it's a little confusing for a long answer. We probably don't want to get into that.
Yeah, we could very easily get into the weeds.
Yeah.
Something else you mentioned, when you are shopping for a loan, a loan officer for a mortgage company, is very important. A lot of people have a misconception about this. There are two different terms in the mortgage business: pre-qualification and pre-approval. Some people, even loan officers that I've dealt with, use these terms interchangeably. You will see this on the pre-approval letter. It says pre-qualification at the top. And sometimes it is not a pre-approval, it is a pre-qualification. Can you clear up that misconception?
Yes.
Tell us why is that important?
Okay, so pre-qualification, in my opinion, is the lazy loan officer approach. That's when a buyer may call a loan professional and they'll have a general conversation. What do you do for a living? How much do you make? What's your credit score? Okay, great. Here's your pre-qualification. You're pre-qualified for X amount of dollars. That's going to put you in the hot water tank, I'll call it, in boiling water.
The phrase that I hate to hear or see in an email is, you should be good at $450,000.
Correct.
Should be?
No. When you're dealing with people's lives and you got a buyer, a seller, a lease, a sale of a home, somebody needs to move on to their next home. It's very important that the loan goes through.
Well, certain.
Right? And if the loan doesn't go through, and unfortunately in our industry that happens from time to time, that messes up the whole thing, right? So a pre-qualification is very high level. A pre-approval, there's two types in my opinion. A pre-approval is when you have a detailed conversation with a client. The client will submit, an application to you, whether online or verbally. You're going to look at their credit, a full-blown credit report. You're going to look at their income documentation. you're going to look at their assets, and then you're going to take that information, review it, and all lenders, brokers, and banks, we pretty much all use the same system, right? Once we have that all assembled, that gets ran through, a national computer model, we'll say. It's called an AOS, Automated Underwriting Engine, and that is the kind of the Bible on how an underwriter is going to start looking at approval. So once you look at that information, review that information, you're able to load that through the underwriting engine, and once you run that scenario, it gives you an approval. And that's the baseline for how a credit underwriter is going to sign off on your loan. Now, some companies, and our company, Movement Mortgage, if we have any questions about a gray area on a loan file, we can actually submit the loan file to the credit underwriter to get a decision before a client actually finds that.
I was hoping you were going to mention that.
Yes, and that's called upfront underwriting. Not all companies have the financial strength to do that because it's overhead, but that is the most valid pre-approval you can get. And there's not a lot of companies out there that'll do that, but it really depends on the quality of your loan professional. If they don't know underwriting guidelines, or they're not taking the time and the effort to have good detailed conversations with their clients and look at the documents and do all the upfront work, yeah, you're putting the buyer and everybody else in the transaction involved at risk. Because if the loan doesn't get approved, you got problems. And we don't want to have any problems.
Back to the drawing board.
Yes.
Yeah.
Yes. So.
Yeah, which brings me to another point. I want to get into some of the things that affect the pre-approval, like the credit score, your down payment amount, and so forth. So maybe you can talk about or explain kind of how the buyer's credit score affects their interest rate, their loan options, and what they can do to improve.
Sure. Credit score, as we all know, for everything is important. On conventional loans, credit score is more important. On a conventional loan, you need a 620 mid score to get approved, right? That's the bottom line. And every 20 points that your credit score goes up, the more attractive your interest rates get. So when you go out to the internet and you see a published rate, that's not a real rate until you know somebody's credit score on a conventional loan. So conventional loans are a little bit more sensitive to credit. And as obviously the scores improve, the better rate that a consumer will get. FHA loans, which are government-backed loans, they're insured by the government, or VA loans for veterans, or USDA loans, they're not so credit sensitive. Most lenders will allow you to go down to a 580 credit score. And you will see a little bit of a price improvement if you have a better credit score, but it's not as sensitive to, a particular person's credit rating. How can you improve your credit? One, if you have revolving charge accounts, you want to keep that utilization at about 30%. If you're maxed out on your credit reports, your credit score is going to tank. You don't want to have multiple inquiries on different industries. Like, you don't want car credit. You don't want to go and get store credit. You don't want to apply for installment credit and mortgage credit at the same time. When you have hard inquiries across different disciplines of credit, your credit score can come down. So that's something we always tell people when you're shopping for a mortgage, be on financial lockdown and try not to go out and extend credit to yourself because it could hurt you.
Right.
Paying your bills on time. You got to pay your bills on time because if you're late, credit score is going to go down.
Yeah, and if you're trying to pay off credit cards, don't miss payments on other credit cards because you want to pay off something faster. It's a process. It takes time, and you have to do things methodically.
And then the other thing you don't want to do is you don't want to close your credit accounts down. You might have a credit card that has 15 years of credit history. If you think that it's a smart idea to pay that off and then close that account, that'll actually have an adverse effect on your credit.
Huge misconception.
Yes.
Yeah.
Yes. And then, credit score is important if you're a first-time home buyer too. A lot of the down payment assistance programs that are out there where you can get help either from, a state or local agency or a national lender like us. Sometimes the credit standards on those types of loan products have to be a little bit higher to qualify. So that's why credit's important. And it'll open up a lot of doors. And having good credit's going to impact your home insurance rates. If you go buy a car, it's going to impact your car rates. It's going to impact your credit card rates, your student loan rates. So it's super important to have credit.
Here's a good question for you.
Sure.
Because we've had a couple clients like this who are looking to get a loan, but they don't have credit. They've never used credit cards. How does that affect their pre-approval process?
From a technical standpoint, some loan products you actually don't need a credit score. Okay. You can use alternative credit. The way the algorithms and the approval process work, sometimes that's a little bit more challenging. But in order to get credit, the best thing to do is to go get 2 bank-secured credit cards, where you might walk into your local bank and you'll put $500 on deposit and they'll give you a credit card for $500.
Okay.
And then I coach a client on, hey, instead of using cash for the gas tank, put $20 in. When the bill comes in, pay it down to $1.
Pay it quickly.
Keep a balance on it, pay it down to $3. You're going to have low interest expense. And that usually takes anywhere from 3 to 6 months to establish credit.
Okay, so it's pretty
if you
quick.
have no credit. Yeah.
Okay.
Yeah. I mean, most people have credit, but sometimes, people pay cash and, their families and their parents and grandparents said, hey, if you can't pay for cash for it, don't put it on credit. And that's actually good, but it's kind of bad sometimes, when it comes to getting a mortgage. So you have to have credit.
The other thing that people are often have questions about is down payment. Now, you and I know there's a lot of misconceptions. People often think I've got to save 20%. And in today's market, with houses $300,000, $400,000, $500,000, that's a lot of money.
Big number. Yeah.
So can you talk about what role does the down payment have in the loan process? How do people determine how much to put down?
Yes. So everybody's going to have a different financial fingerprint. Everybody's going to have a different set of parameters on their financial wherewithal, right? So the big misconception, and we still get this to this day, is when I'll get a first-time home buyer that'll call and we'll go through their pre-approval and they say to me, my dad told me that I need 20% down before we can make an offer on the house, which is completely wrong. And here in a nutshell is kind of what you need. On a conventional loan, the minimum, you need a 3% down payment. On an FHA insured loan, which is government loan, you need 3.5% down. On VA veterans, if they have full entitlement based on their length of service, you could put 0 down. And USDA loans is another loan product in rural areas where you also don't have to put any money down. Now, that's one strategy. So, in conjunction with loan products, you also can get down payment assistance through, either grants, down payment assistance programs, and that works, and every client has to figure out what their budget is, right? Now, in today's market, though, you have to be careful with that, because if you're not showing financial strength and the ability to put a down payment, if you're in a competitive situation, it could get challenging. The seller might not take your offer. For example, if somebody's putting 30% down and we're not putting any money down, the seller might look at that a little differently. So, again, it's every client's going to have a different financial fingerprint. Every offer on every house could be different. And, you really have to work with the buyers, the real estate professional, and the loan professional to kind of put it all together.
Yeah, that's something we've worked on over the years, is just coaching the buyer to understand what the negotiable terms are in the contract and how to best navigate a situation where we've got multiple offers, making that offer the most attractive thing that as possible. And those negotiable terms are the closing date, like you mentioned.
Correct.
Your loan type, if that's something that's an option to you, going conventional versus FHA versus VA, your down payment amount, the inspection periods. You can change the inspection periods. Oftentimes, I know I can get inspections done and over with in a 7-day period. So I'm often shrinking the inspection periods to help buyers get the offer accepted. Depends on the property quite a bit, because if the property needs a bunch of work and you're going to need some time to get through the house to really look at some of the details of the home, it might take longer.
Yeah, I think the biggest thing is having full communication across all parties.
Mm-hmm.
You know, the realtor has to be in tune with the lender and the buyers have to have discussions.
And that's not always the case. It's not
Well,
always the case.
no. Sometimes, you know, when you're not connected, I think that's one of the most critical pieces in today's market.
Mm-hmm.
And the market's not scary. You just have to navigate it. I mean, if there's a need to buy a home, you got to figure out the best strategy. You know, the market's not necessarily gloom and doom. It's just tough right now.
Mm-hmm.
You know, for a buyer, it's tough. And if you don't, you know, if you're going to play, you know, a football game and you know the opponent's tough, your coach is going to come at you like, hey, look, that team is tough. We're going to get mentally prepared. We're going to get physically prepared. It's the same thing with the housing market. Doesn't mean it's a bad thing and there's a black cloud over it.
Mm-hmm.
It's actually a great time to buy a house. Home prices are going up and up and up and up and up. So people are making equity.
Lots of opportunity.
You know, there's a great opportunity to build generational wealth in a market that's appreciating at a higher than normal pace.
Mm-hmm.
And, you know, we're not going to go back to 2007 and that crisis. That was a whole bowl of wax. And you mentioned that earlier. You know, if you rewind the tape back to 2007, you know, there was about 3.8 to 4 million homes for sale in any given month in the United States.
Right.
And in today's market, if you go back and look at 2024, that number could be 700,000 to 1 million homes for sale in any given month. So,
quite a drop.
You know, the inventory challenges that we face is what's driving price and the competition. So until that, and I don't know how we fix that, but until that kind of resolves and changes the other way, it's a seller's market right now.
True.
So we got to mentally prepare our buyers and financially prepare them. You know, how do they leverage their finances and their pre-approval in conjunction with how you present an offer?
Mm-hmm.
And that's how we're going to win.
And when there are changes in the market, like more inventory coming on the market,
Mm-hmm.
or fluctuations in the interest rate, how does that affect a buyer's ability to get pre-approved?
Yeah, so right now, you know, we're kind of in a volatile market as the market kind of, you know, figures out where rates are going. And, you know, for an example, you know, on a 300K home, if there's a, you know, you could see a 1% swing in an interest rate during that pre-approval phase of somebody looking at a house.
Mm-hmm.
And on a 300K loan, if the interest rate shifts 1 point from the highest to the lowest, that's about $200 a month in someone's budget. So that could impact somebody's pre-approval.
Sure.
Right? You know, as you step up the ladder, as home prices go up, when you're looking at a 700K house, if you had a 1 point interest rate swing during that pre-approval time frame, it could affect affordability. The monthly payment change, you know, on a 700K house with 1% interest rate fluctuation, it's about $465 a month.
Mm-hmm.
So that's a huge swing in somebody's budget and cash flow.
Mm-hmm.
So, you know, that's something that your loan officer should be on top of. When you have a pipeline of, let's just say, 40 pre-approved clients, you want to make sure your loan team is watching the market, watching how close people's affordability is. You know, some people are max pre-approved. And if the wind blows and the rate goes up a quarter point, they're no longer looking at that particular range of house.
Mm-hmm.
So you definitely have to be in communication with all parties, knowing what's going on in the market and what people's boundaries are.
That's why we work so closely together, because we've got to be on the same page.
100%.
And the other thing that I think that people just don't get
Mm-hmm.
is, and you and I have talked about this before, and we've gotten offers accepted because you are a local recognized leader in the industry. Can you talk about the difference in working with a local lender versus a big box lender?
Well, big box lenders aren't necessarily bad.
Close to them.
But real estate's local. As much as we're on the internet, as much as there's resources on the internet, you can go out there and get baselines and information. But in today's market, when it's tough for a buyer, sometimes deals are getting accepted because the listing agent has a relationship or knows of the reputation of that particular local lender.
Mm-hmm.
And if they know, like, they're going to deliver and their pre-approvals are 100% always valid, that could be important to a seller. And I'll use an example. A seller is moving 3 states away and building new construction, and they have a deadline. If that lender doesn't deliver, or that the listing agent receives a pre-approval letter from somebody they don't know, or a big box lender that maybe they had a bad experience with, and there's other options,
And there are
for the seller.
plenty of those experiences.
You know, a local trusted lender that uses local appraisals that's fully compliant, you know, could make or break a deal. And sometimes, you know, the strength of the mortgage company or the particular mortgage rep could impact the seller presenting that to their client.
Mm-hmm.
You know, so real estate's local, in my opinion, always has been. We can use technology and the internet for a lot of stuff. But in this market, relationships, whether the buyer agent, the seller agent know each other, does the seller agent know the mortgage professional? Do they deliver on time all the time? And if so, that can help. That can help.
Right. Yeah, we've gotten offers accepted because the
Oh, yeah.
seller agent has worked with you before, and
And there's a little bit of
knows your
strategy
details.
to that I'm not going to get into the secret sauce of what I use and what we use together. But you know, back to having a great real estate team and full communication when you're presenting an offer, 100% critical. 100%.
So getting your offer accepted requires a team approach, like we've talked about, having all parties on the same page, strategizing with those negotiable terms on the contract, using somebody who's local, somebody who's recognized, making sure that you have optimized the product that you're using for that particular market, that particular home, that particular price point, and all those things combined gets your offer accepted.
It could, yeah. Now look, not every offer has competitive situations.
True.
You know, we've had deals where, you know, there was no other offers and we were able to get a seller's assist, which means the seller's willing to help contribute to the closing cost of a buyer. You know, so it really depends. It's case by case basis. But most of the time in today's market, you know, you are going to see multiple offer situations, and how do we strategically plan around that?
Right. Or the seller's just going to wait. They're just going to wait it out because they know buyers coming along. There's so few things available. Somebody's going to buy the house.
Yeah, most of the time too, if a listing agent is smart, they're going to price the home right. So if a house is sitting for 90 days, obviously it's either price or condition. Or the agent.
If it's not compelling, it's not selling.
Yeah, that's true.
As they say.
That's true.
Yeah.
But it is super important. In 20 years of being a mortgage professional, I've never seen it be more important to have the mortgage professional and the realtor working with the buyers, coaching them up, articulating the conditions, talking about interest rates, seasonality, you know, supply and demand. And until, you know, sometimes it takes a buyer, you know, multiple, you know, offers to get stung by the bee to realize that, hey, it's competitive and this is what we need to do.
Yeah, and that's another good topic of conversation. Having new buyers in the market who maybe they're first-time home buyers, right? Maybe they haven't purchased a home in a market like this. Maybe they haven't purchased a home for 20 years. They think they're going to come into the market. You know, we get them pre-approved. We start looking at homes, and they think, you know, let's say we see a home for $450,000, and they say, I want to put an offer in at $425,000. What do we say to those people, Mike?
Well, I'm not a real estate agent negotiating a deal, but I always come up with, you have to start somewhere. So the first important thing is are you comfortable at this price? Does it meet your payment and your out-of-pocket expectations, right? Now, we all know that data doesn't lie. So if you have a client that's looking in a particular area, you can go back and look historically over the last 12 months to see what the action is in that zip code. How many homes are selling? How fast are they selling? And are they selling over price? Meaning if that home is for $450,000, you know, and it's in Haddon Township, New Jersey, well, like you can look at the data in the MLS to see that 82% of the homes are being paid 103.6% of the original price.
Right.
So that strategy of putting an offer in 25 grand below an asking price, when we know based on the last 12 months of data that most people are buying a house within 30 days and paying 3 or 4 or 5% above ask. So the only thing you can do is share data, share information that's accurate to the local market, because 2 towns away, it might be a different story.
Sure.
So that goes back to the importance of a great real estate professional that knows the data, knows the counties, knows it by street, neighborhood by neighborhood, subdivision by subdivision. And then sharing that information with your mortgage professional so you can kind of put that into perspective. Paying over asking price isn't necessarily something that's bad, right? I mean, sometimes a listing agent, and keep me straight on this, may list a 500K property 20K below the actual comparative price. And what that does is it stimulates people and say, hey, this is a great deal. The next thing you know, the open house is full with people.
Incentivizes multiple offers.
But let's break that down. What are your choices? If you're renting in today's market and you're paying $2,500 a month, and over the course of 12 months of waiting, that's 30 grand in rent. That's a zero that you're getting back. So if you think about a house for 500K, and if it takes 525K to win the offer, the question that you want to have with your client is, how long are you going to be there? If you're going to be there for 10 years, 25 grand, is it going to make a huge difference? And then you got to evaluate the cost of waiting. If the current market's yielding 5% year over year for the last 2 years in that township, that house today is 500K. Next year, it's 525. So if you pay 500 today with a 25 over asking price, in a year you break even. Now, if you wait a year, you just spend all that money on rent, and you missed out on the equity swing. If you wait 2 years, that house could be 550. So people miss out on that $50,000 equity swing. And what they're not understanding is that typically, if they're putting 10% down, they're going to borrow a lot more over time. And when you put all that math together, if their horizon's 10 years, a $500,000 house that could cost them $130,000 in generational wealth between equity, borrowing more, paying interest on a bigger loan. Because most people aren't going to save a tremendous amount more money in that 12 or 24-month period that sometimes it takes to find a house in today's market. So you gotta look at the cost of waiting. You gotta understand the data, and if you explain that to people, they're going to make a better and more informed decision.
Right. Yeah. I think in this market, even having new buyers come into the market, working with new buyers in the market, I would rather have them put a $425,000 offer on a $450,000 home, maybe once or twice, right? Just so they learn that's not going to get accepted. This is what the house actually went for. It actually sold for $460,000.
Yeah.
So that over a period of time, they can understand what it's like in this current market.
And again, it goes back to a trusted real estate professional, and every deal is going to be a case-by-case basis. Maybe they could get a house below asking price. Does it happen? Yeah, we're still seeing it.
We have done that. Sure.
But it's not the norm. So you have to prepare and coach people for what's the norm and how do you win. In a normal market, you can negotiate everything. But we're not in a normal market. We haven't been in South Jersey for 5 years. So if somebody needs to move or has a desire to move, it's our job to articulate this information and coach them so they can make the most informed decision about buying a home. It's a big deal. So
True.
Yeah. So, back to, dealing with competent professionals. People are looking at price, they're looking at interest rates. Having a low rate with incompetence behind it as your loan professional is not really going to solve the problem. So,
might not get your offer accepted if it doesn't have a good strategy behind it.
100%. I agree with that.
So, Mike, when it comes to offers, how does the strength of a buyer's financing play into offer acceptance? And what can agents do to help position their clients favorably?
Yes. Well, as we all know, there's a bunch of different loan products. There's down payment assistance programs. There's first-time home buyer programs. You could put more down. You could put less down. Getting an actual mortgage pre-approval may be the easiest part of the transaction. You might have 3 or 4 options as a buyer. Getting your offer accepted could be a little bit more challenging. So when you have a team of professionals coaching, a new home buyer or a buy-up buyer or a downsizer per se, understanding their financial boundaries, and sometimes you have to use leverage across different financial instruments, I'll say. How do you build that pre-approval strategy so when that offer gets presented, it stands out from other offers if we're in a competitive situation? So, back again, like working with a really well-qualified, mortgage professional in conjunction with a really well-qualified agent is going to be key. And everybody has to start somewhere. So, if you're new, like as an agent or a mortgage rep, that shouldn't be discouraging, but the quicker you can learn how to navigate through the market, the better you're going to be.
Yeah.
And it really boils down to the communication and how you leverage things. I mean, you're going to come up with things like, how do we have less contingencies? Do I have to pay off my house in order to qualify for the next house? So we're going to evaluate that. And if there's a way that a buyer can carry both mortgages in a short period of time, even though it seems scary.
If that means getting the offer accepted.
That might mean getting your offer accepted, not having that contingency. And most people have equity now, so there's a lot of things you can do. If you could carry both mortgages, or if you're going to have a tenant come in and rent your current house, use that as leverage. You could use short-term lending through your 401k to create larger down payments, and then when you sell your house, you pay that loan off within 60 days. There's a lot of different things that you have to consider. You have to consider appraisal gaps when you're putting an offer in, paying over asking price.
That's a big one.
And how do you put someone's financial fingerprint together in order to make an offer successful? I mean, that's crucial when it's competitive.
Right. So appraisal gap is huge sometimes.
Oh, yeah.
Because you've got to get an appraisal on the property. If you're making that purchase, most of the time, you need an appraisal. Mortgage company is going to order the appraisal.
Correct.
They're going to figure out, is the home worth what the sales price is?
Yeah, let me give you an example on that. If a client has resources to put 20% down, okay, and they're going to pay 5% over asking price, and they, without a lot of heartburn, a taxable event, something going crazy with their budget, if they could show 20%, if the appraisal comes in 5% light, and sometimes it does because you're paying over asking price, you could shift your loan strategy from 20% down to 15% down.
We have done that.
And the 5% differential you pay in cash. So it's important to show the strength of the buyer when you're putting that offer in.
Absolutely.
And that's just using leverage and, looking through people's financial fingerprints and how do you put it all together.
This is why I love working with you, because you are creative.
Well, you have to.
You think outside the box, and you look at all the options and create a great strategy for buyers.
And that's important. If sometimes loan professionals, they just want to do a pre-approval and move on to the next one. But each case, you have to really dig in and look at people's financial wherewithal and help them build something that's sustainable so they don't get themselves in hot water by making a uninformed bad decision or a quick decision.
Right.
Hence why you take the time, the extra 30 or 40 minutes to do a pre-approval the right way. What is it, the old adage, an ounce of prevention is worth a pound of cure? Like when you set your loan up,
haste makes waste.
Do you want your loan professional to have a 10-minute conversation and shoot a pre-qualification to your inbox, or do you want to go through details and make sure that you have the right strategy at the right time in the market, with the right professionals?
You and I have cleaned up messes before that other loan officers have made for people.
I mean, it's not uncommon for a loan professional to pre-qualify somebody for a $400K house, and then when you dig into it, their affordability is $320,000. Huge difference.
Just a little bit.
Yeah. So again, you have to take the time. You have to do things right, and that's how you're going to be successful in today's market.
Right. So, Mike, I appreciate your time. This conversation has been chock full of lots of good tidbits, but if you really want to synthesize this, let's start a conversation. We can get you on the team. I know that this content is helpful, so please like and subscribe to the Choose Kruse channel, and we'll be coming at you again soon.